Good afternoon. We'll get started in just a minute. We're going to give everyone who has registered a chance to join our call, and we'll get started, like I said, in just a minute. Good afternoon, and welcome to Wage and Hour Law Part 3, How to Calculate Overtime. Today we will cover how to properly calculate overtime premium payments under the Fair Labor Standards Act. This is the third and final installment in this series. If you've not seen or heard the prior two installments, they can be downloaded from the Offit Kurman website. As is always the case, feel free to submit questions using the webinar app bar, and I will answer as many of them as I can. Now, hopefully you've turned into the prior two installments in this series, but for those of you who have not, my name is Russell Berger, and I'm the chair of the Labor and Employment Group here at Offit Kurman. I like to think of myself as a professional problem solver, and most of my work pertains to employment, and more specifically, wage and hour problems faced by businesses. And those wage and hour problems occur both in the context of lawsuits as well as in counseling and compliance. As I have previously said in this webinar series, there are three areas where employers tend to go off the rails when it comes to wage and hour compliance. Those areas are proper classification of employees, meaning whether or not an employee is exempt or non-exempt, or whether or not an individual is an employee or an independent contractor. And then secondly, timekeeping, which is how many hours are actually worked, what constitutes work hours. And then third, determining the proper rate of pay to pay an employee, a non-exempt employee, for overtime hours, which is what we'll be discussing today. But first, I think it makes sense to have a quick refresher on the first two categories. Number one, you do not give yourself a chance of properly complying with the Fair Labor Standards Act if the employee is not correctly classified. So by that, I mean that if an employee is classified as exempt when they're actually non-exempt, you're extremely unlikely to be tracking time and paying overtime premiums. So if you go off the rails on classification, then you have no chance of saving yourself, and the damages can be extensive. So with that in mind, my advice is to be very conservative with classification questions and to err on the side of classifying an employee as non-exempt. And part of the reason I suggest that is because you have more control over other areas of FLSA compliance, specifically hours and method of pay. So, and we'll discuss this a little bit later on when we talk about commission payments and overtime. It's a lot easier to say to an employee, you're not allowed to work overtime hours, you're only allowed to work X number of hours per week. Or to say to that same employee, here's how we're going to pay you, here's the adjustments we're going to make to your commission rate, than it is to say, you're exempt, you're non-exempt, and have that hold up. Misclassification is more of a legal conclusion where unless you change somebody's job description, you don't have a whole lot of control over it as an employer. So I think it makes sense to be conservative on misclassification, knowing that if you really only want to pay this person $35,000 a year, but you still want to pay them a commission, there's ways to manipulate the math or the hours to get to that same result. Now, the second and the third main categories of concern when we're talking about wage and hour compliance is timekeeping. And it's critical that the hours worked by a non-exempt employee are tracked accurately. As I just mentioned, you have some control over how much an employee is permitted to work, and you certainly, as the employer, can prohibit overtime. So something I'll often include in an employee handbook, for example, is a provision that states non-exempt employees are not permitted to work in excess of 40 hours per week unless they obtain express written authorization from their manager. And as we talked about last week, if someone does in fact work overtime in violation of that policy, you are likely still going to have to pay them for that overtime that they worked, but that employee is also subject to discipline, so up to and including termination. An employee can't just work when you've asked them not to and not face a consequence for it, although they still likely have to be paid for it. So again, that's an example of being able to control the hours worked and making sure that your overtime costs don't become a runaway cost because you can control the hours. Now we turn to the third area of frequent wage and hour issues, and that's the calculation of the overtime rate. And to set this up, you've properly classified the employee as non-exempt. You've properly tracked their hours, so you know exactly how many hours they've worked. Now you're left with the question of, what do I owe them? What do I need to pay? And I think that most people, at least in the employment space, understand that overtime is paid at time and a half. But the reality is it's a little bit more complicated than that, because the obvious question is time and a half of what? So the law uses what's called the regular rate for overtime premium calculations. And the regular rate is a way to uniformly write laws when employees get paid differently. And employees do get paid differently. Even non-exempt employees get paid differently. Some are hourly, some are piece rate, which means essentially by the job. If you get this project done, you get X amount of dollars. Some are on salary, and that can mean salary, $52,000 per year, salary $200 a day, salary $1,000 per week. It can mean any of those things. Employees also get paid commission and other forms of performance-based pay. And importantly, employees also get paid combinations of these things. And so what the regular rate does, it's a way to convert all these different methods of pay into one standardized hourly rate. And then the law applies to that standardized hourly rate to inform us as to how to properly calculate. So let me give you an example. And let's take the case of someone who gets paid a weekly salary, and let's call it $1,000 per week. The way the law works is, assuming you make this clear, is that $1,000 covers all hours worked in the week. You can set a salary for $1,000 for 40 hours, or you can set a salary for $1,000 for all hours worked. In theory, almost everyone who would consciously think about this would choose $1,000 for all hours worked. And you can pay a non-exempt employee $1,000 salary per week for all hours worked. What that what that then means, though, is if the non-exempt employee is getting paid a weekly salary, works in excess of 40 hours in the week, you still have to pay an overtime premium to that employee. However, since the $1,000 is spread across all hours worked and not just 40, you've already paid the time portion of time and a half for that employee. So I think it would help if I gave you an example. Let's assume that the non-exempt employee who's making $1,000 per week, works 50 hours in the week. You take the $1,000 per week pay and you divide it by the 50 hours worked in the week. That works out to $20 per hour. That's what you've already paid the employee pursuant to the salary. However, what the law says is you've got to pay the half-time portion of time and a half, which is the time and a half of 20 would be $30 an hour. You've already paid the 20, so you owe an additional $10 an hour overtime premium for the 10 hours of overtime work. So in this scenario, the overtime premium would amount to $100 for that week. If in the next week the person worked 40 hours, they would only get paid their $1,000 salary. In the following week, if they worked 35 hours, they'd still get paid that $1,000 salary. And then if they worked the next week and they worked 45 hours, you would go through the overtime calculation again, but instead of dividing by 50 to get the regular rate, you would divide by 45. And then you would come up with the half-time rate. You would then multiply it by 5 overtime hours instead of 10. So that's how the regular rate works in practice. Another important note with respect to the regular rate is that the regular rate cannot be less than the minimum wage, which, when you think about it, makes a lot of sense. If the law says that non-exempt employees must be paid at least the minimum wage for all hours worked, and you have a $1,000 salary regardless of hours, and then you have someone work 200 hours in a week or 150 hours in a week, then they're going to fall below the minimum wage, and that's problematic. As a starting point with respect to the regular rate, it is critical to know what compensation and what categories of compensation go into the calculation of the regular rate. And in this respect, I think it makes sense to assume that all pay is included unless specifically exempted. So drilling down on that, the regular rate includes all pay for work performed, which comes in lots of different methods, and we'll talk about that in a moment. But where I think it makes sense to start this conversation is what's not included and what the law says should be excluded from the regular rate. So, for example, if you reimburse an employee for expenses they incurred on your behalf, that's not payment for work performed, that's reimbursement. So that wouldn't be included in the regular rate, which is, as a practical matter, is why, like if I get an expense reimbursement check from my firm, it comes out of an operating account. It's a live check instead of direct deposit. It's handled mechanically very differently than wages. Another category of payments that are not included in the regular rate, and this is subject to some specific requirements, are premium payments for overtime on holidays and weekends. So the example of this is, we just talked about paying time and a half for overtime, but if you pay a double time premium for holiday work or weekend work, then that additional premium that you're paying need not be included in the regular rate calculation. And again, if you have those scenarios, you should look a little bit more closely at the regulations because it's a little bit more detailed than that, and I've probably oversimplified it a little bit. But for practical purposes, if you're paying premiums for holidays and weekends, you have some flexibility with respect to how you treat that for purposes of the regular rate. Another category that does not get incorporated into the regular rate is discretionary bonuses. And I like to think of this as, obviously there's no obligation on the part of the employer to pay this bonus. They get to the end of the year, hey, we had a really good year. I want to give everyone $1,000. That $1,000 payment wouldn't get incorporated into the calculation of the regular rate. Similarly, special occasion gifts. So if you give out a Christmas bonus or an administrative assistance day bonus, things like that, a birthday bonus, those would not be incorporated into the regular rate either. And then the last category of compensation that's excluded from the regular rate is effectively PTO. So if you pay, for sick leave, which everyone in Maryland with 15 or more employees has to offer paid sick leave now, that paid sick leave wouldn't be incorporated into the regular rate, nor would vacation, general PTO, holiday pay, those sorts of things. So that's what's excluded from the regular rate. Now, if the payment, the form of compensation from the employer to the employee, is not in one of the excluded categories we just discussed, then the law requires that it be included in the regular rate. And if you don't include it in the regular rate, then, or at least in the numerator portion of the formula that gets you to the regular rate, so therefore the dollar amount is not high enough, the regular rate's then going to be too low, which means that whether you're paying a half-time premium or time and a half, the overtime premium is then going to be too low, and you're going to be in violation of the FLSA. And as we've talked about earlier in this series, violations of the FLSA can be very costly, and that's because under the FLSA, the amount owed is often doubled as liquidated damages are permitted by the law. Under the Maryland state law, they can even be tripled, and there's also fee shifting. So if you make this mistake and you're wrong, you just haven't done it right, under the FLSA anyway, you can be looking at double damages plus the other side's attorney's fees plus your own attorney's fees to deal with the issue. In addition, the way the FLSA works, it makes it easy to form a class. So if you had a group of employees where you failed to include commissions in the calculation of regular rate for all your salespeople, those salespeople could all form together and pursue a class claim. So instead of dealing with those double damages and attorney's fees for one person, it could be 5, 10, 20 people. So that's something that should create a real, ignite a real fire to ensure compliance with this. So with that in mind, I've included some bullet points on this slide that obviously are not exhaustive of all the things that go into the regular rate, but I think cover most of the categories and cover most things that you're going to have to deal with. So running through those, the first is base pay. And as I mentioned, that could be in a number of different forms, whether it's hourly, salary, piece rate, what have you. Whatever the base pay is, that's going to go into the regular rate calculation. The next category, and this is one that I don't think I've ever seen an employer do this correctly without having run this by an attorney, but it's commissions. So what happens a lot of the time is that a company will have inside salespeople, for example, that get paid an hourly rate and a commission on top of that. And the hourly rate, so when someone works overtime, they take the hourly rate, they multiply it by time and a half, they pay that as overtime, and they think they're doing everything right. What they often fail to do is to pay an overtime premium on top of the commission payment, which is required by the law because, as I'm saying, the commission needs to be incorporated into the regular rate. And in a moment or two, I'll run through an example of that in a little bit more detail, but that's a key area where lots of employers make a mistake. Similar to commissions would also be non-discretionary bonuses. So these are objective, performance-driven. So, for example, if you hit your sales goal for the month, here's the bonus you're going to get, or here's a volume bonus on sales. You hit that bonus, it's objective, it's just a yes or no question, or it's a math formula that determines what the bonus is. That's performance driven, and because it's payment for work performed, it belongs in the regular rate. Again, along those same lines, production bonuses are also included in the regular rate. So that I often see that in terms of a position where, if you complete 10 units this week, or 50 units this week, or 100 units this week, you're going to get this bonus. And it's a $100 bonus for every 10 units completed. And that's a production bonus. That type of bonus needs to be included in the regular rate as well. Similarly, and this is probably a little bit, if not a lot bit more obscure, is prizes. So certain companies that have a large sales force might run sales competitions and have prizes at the end. So if you, all the salesmen that hit this target are entered into a raffle, and the winner, wins a prize. Theoretically, that prize, the value of that prize, is supposed to be incorporated into the regular rate. If it's a monetary prize, it's a little bit more transparent. If it's non-monetary, that's a little bit more complicated. And while it's required to be included, I would hazard a guess that it's extremely unlikely anyone sues because they weren't paid overtime on top of a prize that they won. But theoretically, that's what the law says is supposed to happen. And then lastly here, payments that would otherwise be excluded but aren't consistent with the requirements of the law for exclusion. So by that I mean, all the things we talked about on the prior slide that are excluded, but if you mess it up. So, for example, like I was talking about, there being additional regulations with respect to premium payments on holidays and weekends. If you don't follow those regulations and do it properly and the way the Department of Labor's regulations say you're supposed to, then that premium payment that you thought was excluded from the regular rate would have to be included. And that's the same for the other excluded categories as well. So at this point, I think it'd be helpful to work through an example, but I'm conscious of the fact that I think too much math in a webinar could present a big challenge. So I'm going to try to ease into this, but as I've mentioned, feel free to submit questions if you're having a hard time following this. But I'll do my best to explain the math as we go. So let's start off with this example. Imagine that it's an inside salesperson who works in a call center and is paid by the hour. And they also receive a commission on top of their hourly pay. So what that means is when they work overtime, there's really two components of their overtime premium, because they have to be paid overtime on the hourly rate as well as on the commission. And so I like to think of this as kind of a two-part process. And the good news is that part one is relatively easy. So taking the hourly rate, you simply multiply the hourly rate by time and a half, and you multiply that by the overtime hours. So to use an example, let's assume that this employee makes $10 an hour as an hourly rate. And they work 50 hours in the week. the overtime rate for based on the hourly rate is $15 per hour because that's 1.5 times 10. And you would then multiply that $15 per overtime hour times the 10 overtime hours to arrive at a figure of $150 owed of overtime premium. So just on the base pay component or the hourly rate component, $10 an hour times 40 hours is $400. $15 an hour overtime premium times 10 overtime hours is $150. That's a total of $550 just based on the hourly rate portion. Now, we're to the second part, and this is where the challenging math comes into play because you have to incorporate a commission payment into the overtime premium. In the Department of Labor regulations, there's literally an algebraic formula, and I think that's because it's easier to express what needs to happen as an equation than in words. But that being said, I've broken this down step by step. So in my hypothetical, this person, even though they're getting paid weekly, and the unit of measurement for overtime is the work week, is getting paid a commission on a monthly basis. So the first thing that you need to do is you need to convert the monthly commission amount into a weekly commission amount so that you can then complete this math process. So the way you do that is you take the total commission amount, and in my hypothetical here, and I picked this number for a reason because it makes the rest of the math easier. Let's assume that the monthly commission is $4,333.33, and I promise you that's the last weird number I'm going to throw at you. But you take that monthly commission amount and you multiply it by 12 months. So that then gets you to 4333 times 12 is 52,000. You divide that amount by 52 weeks in a year, and you get $1,000 per week for that month. So the week that we've been talking about where the employee worked 50 hours, the amount of commission that is attributable to that week is $1,000. Then you would take that $1,000 in commission and you would divide it by the total hours worked in the week, in this case 50, and arrive at a figure of $20 per hour. That is the commission-based regular rate. And you pay $20 an hour for all 50 hours worked. And now, like we talked about earlier, this becomes a similar calculation to how you treat salary for all hours worked. So you would divide the hourly commission in half. You would divide the commission-based regular rate in half. So you divide the $20 per hour in half to $10 per hour, and that's the amount of overtime premium that you owe for all overtime hours worked. So you take that $10 per hour overtime premium, multiply it by the 10 overtime hours, and you're at $100 in overtime premiums based on the commission that you would then have to pay to the employee. So, to break it down and to summarize it, for this particular week, the employee earned $400 in hourly base pay, earned $150 in hourly overtime premiums, earned $1,000 in commission, and $100 in commission-related overtime premium. So I hope everyone follows the math there. I tried to use as simple numbers as possible for this exercise. And so one point I want to make, though, now that we're shifting out of the math, is that it's okay to pay the commission-based overtime when the commission is paid. You couldn't, if you're paying someone weekly or biweekly and the commission isn't paid till the end of the month, you can't pay an overtime premium on that commission until you actually pay the commission, and it's not due until you actually pay the commission. So what I recommend is that, and part of the reason I broke this down into 4 categories of compensation is that I think all 4 of those categories should have separate entries in your payroll system and on your pay stubs. So if I'm an employee and I get my weekly paycheck, it'll say, base pay or hourly pay or whatever the standard is for your payroll company, $400. And then it'll say, overtime pay, $150. And then it'll say commission, and it'll be blank because you didn't get paid a commission that pay period. And then it'll say, and this is one where I think you have to affirmatively work with your payroll companies because they certainly don't default to this setting, is to have that 4th category that's, overtime adjustment based on commission or commission overtime, or something that makes it clear that this is, what this 4th category is. That's also going to be blank on the weekly pay stub because you're not getting paid that at that time. But then when if you do a separate payroll for the commission checks at the end of the month, then, the hourly pay and the hourly overtime are going to be blank, and the commission lines are going to say 1,000 and commission overtime 100. And it'll total. There'll be cumulative totals for all that, and it'll all be in the pay records, and will be very clear what's being done. Because what I've seen happen is even where employers try to get this right, it's not really clear what category is what, and then you end up with plaintiffs' attorneys arguing that certain category, even the overtime premiums that you thought you were paying on a commission look like something else, and that they should go into the regular rate and you should be paying an overtime premium on top of them. So it's really important that I think you make this as clear as possible. And again, I think you really need to work with your payroll companies to get this right. And obviously I'm using commissions as an example, but it could be any of the other, additional compensation categories that we're talking about. Most payroll companies do not default to a setup where overtime premiums are paid on them. So if you're not, if you haven't had the conversation with your payroll company, odds are that commission pay, other premium payments, or payments for work performed, completion bonuses, those sorts of things, are not being factored into the overtime calculation, and that can be a pretty significant exposure because, despite what my numbers are, oftentimes non-exempt people that get commissions are paid a very low hourly rate, the minimum wage, and then earn most of their money in commissions. And so not paying overtime on the commissions means you're not paying most of the overtime that is owed. So it's really, really important that you as the employer affirmatively and proactively work to make sure that this is being done. And if you're relying on your payroll company to do this properly, you're taking a pretty big risk. As a final note on this point, and like I alluded to at the beginning, this is something that you as the employer have control over. And by that I mean if you're good with the math or you're good enough with the math, you can work backwards. So, for example, if you knew that you had non-exempt salespeople that work 5 9-hour days because you've got them in a call center and the call center is operational for 9 hours each day, you know what the weekly overtime is going to be. And if you wanted to pay, let's say, a 25% commission on their sales, but that's what you want to pay. You don't want to pay a 25% commission plus overtime, and they're going to work 5 hours of overtime per week. You can run the formulas and dig into the math a little bit, and you can reduce the commission rate so that the commission rate becomes 23%, 24%, whatever the math would suggest it should be, and combine that with an overtime premium so that the adjusted commission and the overtime premium equal the 25% that you're willing to pay as the employer. So obviously you need to make clear to the employee that this is the commission structure. You're actually getting paid 23.5% and not 25%, and that needs to be what the commission plan states. But you know that you're backing into the right result. So that's something you have control over, and it's something that you can do proactively to make sure that you're not getting burned by paying an extra percent or two on commission payments that you don't want to pay because of overtime premiums. So that's something that might be a little more complex, but like I said, it's if you can get the math right and you can get the right agreement or commission plan in place, you can still engineer the right result at the end. So with that said, I'd be happy to take some questions. It looks like we've got some already. Please don't ask me to do math on the fly, but certainly we can talk about the concepts and talk through some examples. So the first question is asking for an example of how to calculate a production bonus for a non-exempt employee based on a weekly pay schedule. So it would operate similarly to what we just went through for commission. So, if the production bonus is, you make 10 widgets, you get an extra $100. I would do it the same way we've calculated, the same example that we've used for commission-based calculations. So the hourly pay is still the hourly pay. The overtime premium on the hourly pay is still 1.5 times the hourly pay. And then on the production bonus, again, you have to determine whether or not it's a production bonus for the week or a production bonus for a different unit of time. But you would convert that production bonus into a weekly production bonus if need be, and then using making it a year, and then multiplying it so that it's a year, and then dividing it by 52 to make it weekly. And then, because for example, you could have quarterly bonuses, and you'd be multiplying it by 4 to get to an annual number, and then dividing by 52 to get back to a week. But I would do it in much the same way, and the numbers might be a little bit different, but I think that's the right way to do it. And I've been discussing regular rate, and from a legal standpoint, the regular rate is the combination of those two things. But since you would be paying time and a half on the hourly portion, and you're only paying a half-time premium on the production bonus or the commission, I think it makes sense to keep them separate for purposes of making the math a little bit easier. I also think it makes sense to keep them separate because oftentimes they're paid at different times. It wouldn't make a whole lot of sense to pay them together. Okay, so the next question is, do we have to take into account a vehicle allowance paid weekly to a non-exempt employee? And I think it would depend on the structure of the vehicle allowance. And I'm not sure exactly. I mean, certainly, like executives at companies have vehicle allowances. I don't know if this is like a salesperson who would be getting some sort of vehicle allowance because they're out traveling so much. But the answer to that is, if you structured it right, probably not. Because I think if you did it properly, it would fall into the category of expense reimbursement that's excluded from the regular rate. Now, if you were going over the top, I guess there's a spectrum for this, because if you're paying, the IRS mileage reimbursement, then you're fine. It doesn't go into the regular rate. If you're giving someone $1,000 a month car allowance, and you're really circumventing, you're giving them a lot of money that isn't just really expense reimbursement, especially for a non-exempt employee. And it's very plausible that some portion of that wouldn't be seen as expense reimbursement, but really just compensation. But that's a question that if you needed a precise answer, I'd look at that more carefully. I'd want to research that because I don't think that's I just see there being a lot of different avenues that could go down and be problematic. All right, so let's see what else we have here. And I guess it's worth noting that the question was about vehicle reimbursement, but that would be true of any other category of reimbursement as well. So it wouldn't necessarily have to be with a vehicle. It could be if you, for example, if you, bought supplies for the office and then they gave you $1,000 check for $100 worth of supplies, that extra $900 could be problematic. So that would be something if you run into that, or if you do something like that, it certainly would seem to me at a minimum that you're taking a sizable risk, and depending on the particulars, you might be doing it wrong. So that'd be something to look at a little more closely as well. So another thought I have here is, and I kind of hit this already, but I want to reiterate that ultimately you're not going to be able to rely on a payroll company to get all this math right and to do it properly. So it's really important that you make sure overtime is being paid properly and the right. And from a payroll company's perspective, they would say the right inputs are not being provided to us for us to be able to calculate the overtime properly, and that may or may not be true, but that's what they would say. And if you look at your contract with your payroll company, they almost certainly say that they disclaim all liability for not calculating pay properly. So it's really going to be on you at the end of the day. So I can't stress enough how important it is for you as the employers to take ownership of this and to make sure that everything is done properly. So with that, I think I've answered all the questions that have been submitted, and thank you for joining me here today. And as I mentioned, there are 2 prior webinars covering misclassification and timekeeping. So now, along with proper calculation of the overtime rate, we've covered the 3 main areas where employers make mistake with respect to wage and hour compliance. So feel free to refer back to these. They'll be on our website. I think you'll get an email where you can download these, or at least a link to the site where you can download the prior webinars. And feel free to use them as reference. And if you have any more specific questions, or you want to work on the math with respect to any of these overtime calculations, I can promise you that even though I am a lawyer, I am at least competent at math, and at least this type of math, and would be happy to help. So feel free to reach out to me. And once again, thank you for joining today.